Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I am your host, Dr. Daniel Crosby. I am joined today by Tim Holland of Orion. He is the Chief Investment Officer there. He is also one of the foremost experts in corny 70s media trivia. Welcome to the show, Tim.
Thank you, Daniel. I'm honored to be on the show and honored to be such an expert on 70s and early 80s pop culture. It's a particular passion of mine. But it's great to be on here with you. I really appreciate it.
No, I know we'll get into markets and Smokey and the Bandit today. So both something to look forward to. So first off, Tim, I want to start by talking about the disconnect that I think a lot of people are talking about between the market performance of 2020 and even early 21 and most folks' experience of that year. You know, you got nearly 500,000 dead in the US. You've got civil unrest, a referendum on race in America, millions unemployed, and the stock market just screams along as though nothing is happening. I know the market is forward-looking. I know the market is not the economy, but this feels bigger than either of those truths. Like, what sense do you make of it all?
Yeah, no, and you're right. The market isn't the economy, and as you know, and as I know, and many of your listeners probably know, the market tends to lead the real economy, right? Going down while the data is still good, sort of anticipating tougher times to come, and going up when the data is still unpleasant, anticipating better times to come. But you're right. This is just such an unusual and such an extreme 12 months, give or take, for our country and for our economy and the stock market, and not to diminish or minimize the healthcare consequences, the financial consequences of this awful pandemic, but to try and square, the circle that you're talking about. For me, it's the policy response, right? It's the Federal Reserve taking rates to zero and spending $120 billion a month buying government bonds and mortgage-backed securities. And it's the federal government spending trillions of dollars that helps explain that disconnect. Because even if the market's not the real economy, it has been an extreme rebound in what we call risk assets, stocks, bonds, you name it. Just about everything has done well in the face of a still awful pandemic and still millions of people unemployed relative to where we were a year ago, and an unemployment rate that's twice where we were a year ago, along with all the other cultural and political challenges you've laid out. So for me, it's just the Federal Reserve and the federal government responding in an overwhelming fashion to the healthcare crisis and then the economic crisis that the healthcare crisis caused that explains this. And without that policy response by both entities, I don't know where we would be. We certainly wouldn't be anywhere near where we are right now in terms of the stock market, the economy going in the right direction, even if we're not all the way back, the jobs that have been brought back and so on. So for me, it's just a policy response that goes beyond anything this country has ever seen in its modern economic history. I think that's how you sort of explain the disconnect, square that circle. And without the Fed and the federal government, we would not be here. We'd probably be, as bad as things still are for so many people, we'd be in a much tougher, much darker place.
Now, I think a lot of people are skeptical of the size of the response. Do you have any worries? What do you say to skeptics or critics of that sort of enormous response?
Yeah, so I would say, what should they have done? Yeah. Right. I get it. We've spent trillions of dollars over the last year. The Fed has spent billions of dollars buying securities. And so the worry is, what are the unintended consequences of that policy response? What does that mean for the country, its solvency, its economy, its currency, all of it over the long term? And no one knows. And so I would say to folks that are worried about that, what would you have had them do instead? And the problem with that is, well, if they had sort of taken a more judicious approach, were more incremental, we may not have gotten in front of this thing from an economic and a market perspective. So we would be living with the still ongoing healthcare consequences of this, and an economy that's in much worse shape, and risk assets that are much lower, which means the average American is poorer than they would be today. So, I don't envy Jay Powell. I don't envy the politicians in DC, because there was no real rule book, playbook for this pandemic and how to respond to it. But I think you want to go big and not to be flip about it, but worry about the consequences later. Because if you don't go big, the structural damage that a pandemic and the policy response to the pandemic of shutting down the economy could do to the economy long term, the destroyed wealth, the destroyed jobs, a lot of that may have never come back. So I think you got to go big and almost worry about the consequences later.
Yeah, well, that's certainly been their approach, and there's no doubt that things were and continue to be so bad that it necessitates something, right? Something.
Yeah, for sure.
So let's turn our attention now to the new year. We have a new president, we have a new look Congress, we have a number of vaccines. What are some of your themes, and what is sort of your outlook for the new year? What are your expectations of the market?
Yeah, and this gets back, our thoughts on 2021 tie back, I think, nicely to the first question, which was sort of the disconnect between the market, most folks' experiences last year, the economy. And so thinking about the economy first, unless we're hit with another exogenous shock, and the way exogenous shocks are, you can't model for them because they do come out of the blue to a certain extent. So, God forbid, efficacy doesn't hold on the vaccine front, or there's another strain of the coronavirus that isn't sort of manageable with the vaccines that have already been produced, or some sort of geopolitical dust up, say, between the U.S. and China. So barring that, and hopefully we get lucky on that end after such an unlucky year last year, the economy should do really, really well this year. 4, 5, 6% GDP growth, the rate of growth we haven't seen since the early 80s, is likely because the federal government and the Federal Reserve have pushed so much money and liquidity into the market, and there's so much pent-up demand. As the economy reopens, people and companies should just go out and spend a ton. And as we know, our economy is about 70% driven by the consumer. So as long as the economy continues to reopen, there's a lot of capital sitting in bank accounts and sitting in people's wallets and sitting on balance sheets that can then go get spent. So the economy should do really, really well this year. I mean, imagine, Daniel, you and your friends, if someone came to you today and said, hey, if you guys want, you can all get on a plane right now and go somewhere nice and not worry about a thing. If most folks, if they have the means, or get in the car and drive to the beach or go somewhere, they're going to do it. Go out to eat, go get a cup of coffee. So the economy should do really, really well this year. The markets, the risk assets, may not do as well as they did last year, partly because they did so well last year. And things like valuation are a little stretched. Spreads in the bond market are pretty tight, which is another way of saying valuation's a little stretched. So we think the economy should do really well. We think the market should be okay, but it's likely the inverse of last year. The economy rips, the markets do okay, as opposed to last year, where the economy started to come back, but the markets rip. So we're directionally optimistic, but really optimistic on the economy. It should be a fantastic year for GDP growth, knock on wood.
Yeah, the market not being the economy cuts both ways, unfortunately.
Yeah.
So we could see a great year for the economy, a great year, hopefully, knock on wood. Just when you were talking about going to get a coffee, going out to eat with friends, I started to daydream, right? Because it's so, it just seems like it's been so long. And
I know
my littlest kid talks all the time. The little 4-year-old talks all the time about, can we do this when Corona's over? And
man.
I think we're all waiting for Corona to be over.
Yeah, no, you're absolutely right. And that disconnect, that's a very good point, does cut. both ways. And so we should all keep that in mind. That helps us set expectations and do all the things that you teach us how to do on a day-to-day basis when it comes to investing in behavior and sort of making sure we're not our own worst enemy. But that disconnect for sure can help the market, and then also can sort of weigh a little bit on the market depending on where you are in that cycle.
Yeah, so we're coming off of a decade of blistering outperformance for the American market, and a decade in which not much has happened internationally, performance-wise. What's your take on emerging markets, international stocks in a post-COVID world?
Yeah, so at a high level, we're, from an asset allocation perspective, we're pretty evenly split between the U.S. and the rest of the world in terms of overweight or underweight. We're pretty neutral, equally weighted vis-a-vis what a portfolio would look like. So we see opportunity both here at home and overseas. And you're right, the rest of the world has badly lagged the U.S. for a long time. We really like emerging market equities relative to, say, classic international or developed equities. Valuation is very attractive. China is a huge part of the EM universe. By most counts, it's about 40% of the major emerging market equity indices. And China was the first country, right, to deal with the coronavirus. Their economy rolled over first and came back first. So, and they continue to do well from an economic perspective. So as long as China can continue to grow and move in the right direction, that's a huge, huge tailwind for EM broadly, and for other EM countries that tend to produce and export commodities right into places like China. So China grew, if memory serves, about 2.3% last year, according to the World Bank. So they are going to be likely the only major world economy to have grown. So if China continues to do well, that's very constructive for EM at a high level. International developed equities, we're still underweight. If you look at Western Europe, again, some of the same old structural challenges that continent has faced before, they continue to face, right? They've got a single currency, but multiple approaches to fiscal policy. And even though we're still dealing with some really difficult days on the COVID-19 front, I'd argue it's even worse over there. They seem to be a little bit behind us, if not other parts of the world, in terms of vaccines and getting that vaccine, those vaccines distributed and to the people that need them. So we're pretty bullish, constructive on EM equities going forward. And you're right, it's been a tough 10 relative years. So parts of the rest of the world are set up pretty well going forward, assuming the world's economy can continue to reopen and we can get COVID-19 behind us.
So I want to talk for a minute about the B word, which is bubbles.
Yeah.
This is the word that I think no one likes to talk about, but I think it's important. Robert Shiller, so the famed behavioral economist, has 6 criteria for diagnosing a bubble. So I'll run them down real quick.
Yeah,
It's
please.
Sharp increases in asset prices, public excitement, media frenzy, stories of people earning a lot of money that cause envy, and interest in the asset class among the general public, and new era theories to justify price increases. So I want to talk about certain parts of the markets, right? SPAC, IPOs, large cap tech, crypto. All of these are experiencing, well, what at a minimum we would call elevated valuations and some really sort of mind-blowing performance lately. Do you think that in certain areas of the market, the criteria for bubble are met?
Yeah, no, I think that's you can make the case for some parts of the market that you just laid out, Daniel, that people have gotten out over their skis and there's too much enthusiasm and too much capital chasing particular parts of the market. It doesn't feel to us though that the stock market overall is there, but think about SPACs or maybe some of the IPOs and maybe people have gone too far too fast. It's interesting about Professor Shiller, is obviously well-known, well-respected, brilliant observer of capital markets, best-selling author. One of the tools he's most famous for is the cyclically adjusted PE ratio, right? The CAPE, and it's elevated relative to its history. The only other couple of points in time where the CAPE has been higher. So again, I have a lot of respect for Professor Schiller and his worldview. The interesting thing, though, about the CAPE and cyclically adjusted PE is he also looks at the yield, the CAPE yield, sort of what's the market yielding relative to traditional fixed income. And I know we're going to get into this in a little bit. And stocks are more attractive than bonds, right? Not to get cute about it, but we tend to live in a relative world, not an absolute world. And so while there are clearly, I think, pockets of frenzy, concentrated in certain parts of the market, stocks, broadly speaking, especially in a low rate environment, are much more attractive, we think, than traditional fixed income, though traditional fixed income's got its place in any portfolio. So yeah, I would agree there are pockets of that. It doesn't feel structural or broad-based to us. Investors, we think, never really came back to equities after 08, 09. So it just doesn't feel like that broad-based excitement. It's more narrow and at a high level, even again, going back to Professor Schiller and the way he views things, his own data set says stocks are more attractive than, say, traditional fixed income, which is a traditional competition for capital for equities. And we think he's right. And then the final point, you do get these pockets of excess. They happen. Sometimes they deflate without any structural damage. If you think about Bitcoin a couple of years ago, going from 0 to 20,000 back to essentially 1,000. So you can have these smaller bubbles unwind or deflate without any structural damage. And we don't think there's anything, again, big enough, were it to be a bubble, were it to deflate, the broader market would be at risk. And again, at a high level, stocks, we think, are still pretty attractive, particularly relative to traditional fixed income.
So pockets of froth, but perhaps not so widespread that people need to fundamentally rethink the way they go about their business.
Yeah, no, agreed. And again, if you look at sort of stocks relative to bonds in the late 90s, it was a complete inverse. I mean, yields were what you could get in traditional fixed income relative to what stocks were offering was just night and day compared to where we are today. And if you go back to 08 and 09, you could argue that wasn't so much a stock market bubble, though obviously the S&P was off 50% peak to trough. It was a real estate bubble that manifested itself in the credit markets, which bled into equities. So yeah, no, I think broadly speaking, stocks as an asset class are attractive, are a little expensive relative to their own history, a little bit, but attractive relative to fixed. And you don't have those warning signs that you saw in the late 90s where just the asset class in general had disconnected from reality.
Well, you brought up fixed income, so let's talk about it. What is the place of fixed income in a world where there's low rates, negative rates in some places? This has historically been portfolio ballast. Yeah. What do we do now for ballast in a portfolio, and do bonds still have a place?
Yeah, we think bonds still do have a place, but you're right. You're starting from a place of very low yields today. What's interesting, though, last year is that while equities did incredibly well, right, for the full year, despite, say, the 34% pullback in the S&P peak to trough, we were up 18. The NASDAQ was up much more than that. Even though we started the year last year with yields low, obviously they went a lot lower, but low relative to their own history. Through those first 4 months of the year when things were very difficult, traditional fixed income did what it was supposed to do, which was catch a bid and offset the volatility in the equity part of the portfolio. So even with the U.S. 10-year at 1.1%, broadly speaking, traditional fixed income remains the only hedge, really, that history shows is the only real hedge to broad equity exposure. So we do think traditional fixed income continues to have a role in asset class portfolios. We're a little more conservatively positioned within traditional fixed income because you're not getting paid to really reach for yield to go further out on the curve. And we do think, fixed income outside of traditional fixed income offers opportunity, especially if the economy continues to come back. Corporate bonds have done really well as have stocks. But broadly speaking, corporate bonds haven't come all the way back in terms of value relative to where they were a year ago. So, yep, traditional fixed income, U.S. government bonds, notes, bills, and the like, really the only hedge for broad equity exposure. But we think you can find yield in other parts of the market where you're getting compensated for taking on some of that risk. But yeah, there's really no replacing, as of today, traditional fixed income.
So you make a great point about it having done its job when it needed to do its job. And I think that's something that folks really need to keep in mind. So from a behavioral perspective, what's your advice to investors who are living through this crazy time, who are probably personally taxed, right? They're going a little stir crazy in their houses. They're, not sleeping well. They're watching the news. What practical steps can they take to ensure that they're not sabotaging their investments?
Yeah, but in all seriousness, though you have obviously we've talked a lot about self-care and good habits and sort of the physical, mental building blocks of one's life, and you can speak to that better than I can. If you take care of that, it probably makes everything else much more manageable. But having said that, from a behavioral perspective, my advice would be, and it can be very difficult and very stressful day to day. Everyone's at home. Some people are schooling their kids at home. Some of those kids have real learning challenges, whatever it may be. Some families have more resources, financial and otherwise, than others. My advice vis-a-vis your portfolio, the investments, not making behavioral mistakes that get you into trouble, would be, we have been here before. We've suffered through pandemics before. It's been 100 years, but we've seen periods of great social unrest and societal change. The late 60s come to mind in particular. But over time, even though things aren't always linear, at a high level, our economy has always expanded more than it's contracted, and markets have gone up more than they've gone down. And our society has found a way to hold itself together and move forward. So, working with an advisor, having a diversified portfolio, all of that, can help someone sort of put periods of great volatility in perspective, look through them, take a longer term view. But maybe the biggest takeaway is just our country's faced incredibly difficult moments in the past, and over time, while not everyone benefits equally, it has become wealthier, safer, and healthier. And I see no reason why those trends would change long term, even if they're interrupted near term. And if you know that and you believe that, that allows you to take periods of dislocation and distress and maybe put them in greater perspective.
I think, to your point, being a market historian, just being a historian broadly, is one of the most powerful things you can do to put some of the short-term dust ups into perspective. We've been through a lot. The 20th century was a horror from sort of a historical perspective, and markets still were market participants were still richly rewarded. So Tim, we're going to begin to close up now, but as I begin to close up, let's get a little personal. Let's talk about your biggest personal lesson of 2020. It was a year of so much tumult and change. What did you learn as a person in 2020 that you're taking with you?
So what I've learned as a person is to try, and again, we've talked about this a lot, and I've read your books, Daniel. I've tried to become very aware of and focused on what I can control, and set aside and to a certain extent ignore what I can't control, because there's so much we can't control day to day, and then you go through a period of great stress like the world's going through right now, and there's so much you can't control, and so much of what you can't control is negative, that if you put your mind on that, boy, you're just going to tie yourself up in knots, and you're not going to be able to move forward. So my greatest personal lesson has been, and we talked about this, self-care, exercise, trying to stay in the present moment, but really focusing on what I can control, which allows me to hopefully be productive and move forward and not get overwhelmed by all the difficulties out there. Not that I'm aware of it, not that I'm indifferent to it, but that's helped me a lot, focusing on what I can control. And another personal lesson, which ties back more to what we all do for a living, is the system held, right? The federal government and the Federal Reserve printed trillions of dollars and took rates to zero and put a floor under the economy and the stock market. And I know that's more of a business lesson than an individual lesson, but for me, that's the most important takeaway from an economic perspective. The system held. The system that's been in place for decades and over 100 years with the Federal Reserve and obviously the federal government goes back even further, held. And if we can face a pandemic of global proportion, civil and social unrest, a healthcare crisis unlike anything we've ever seen, the most dramatic downturn in the economy since the Great Depression, not to be flip about it, but if the system can hold through that, I'd argue the system can hold through anything. And for me, that's the biggest professional takeaway, if that makes sense.
Yeah, I like both of those comments, like being tuned in to what's going on, not being insensitive to the suffering or the hardship that others are going through, but understanding what you can and can't control and making your choices accordingly. And then understanding, like, look, if we can make it through this intact, there's not much that we can't do. And I think all of our institutions, all of our institutions got pushed this year. So,
oh man, yeah. You talk about a stress test, and again, not to be too Pollyannish, because tough times come and tough times can hang around for a long time. But if you think about the last 20 years and three, as professional investors, and three major bear markets, three recessions, a real estate crisis, a pandemic, the awful events of 9/11. I mean, this country's been through a lot in the last 2 decades, and I'm just optimistic that the next 2 decades will be more constructive, will be just easier. And we've come through a lot, we've learned a lot, and I definitely think there are better days ahead.
Yeah, perfect. Well, Tim, we're going to end where we started, which was by alluding to your affinity for the 70s. So we're going to go to the lightning round now. I'll just ask you a question. You give me the first response that comes to your head. All right?
Yeah, go for it.
Okay, greatest actor of the 70s.
Oh man, I know I'm supposed to be quick. I got to go with Burt Reynolds. Burton T. Reynolds. That mustache. Yeah. No, nobody was cooler. And boy, did I want that Trans Am from Smokey and the Bandit, the movie you referenced earlier. I got to go with Burt. He was larger than life.
Well, how about
you?
How about me?
How about you?
Listen, man, I was born in October of 79.
Oh no.
I'm not.
How about 80s?
80s?
Yeah.
I don't know. Patrick Swayze.
Roadhouse is. Patrick Swayze can play any role, right? Dirty Dancing, Nobody Puts Baby in the Corner, and Roadhouse, which is one of the great movies of all time.
I don't know.
At least, from my perspective.
Listen, you're usurping my power on my own podcast. You asked me questions.
Sorry.
The first movie that came to my mind was Point Break, and I'm very ashamed of that.
Johnny Utah, Bodie. Yeah. I've got friends who named their son Bodie because of that movie, and apparently he's just a handful. And I'm like, what'd you expect?
What'd you think, man?
Bodie, you kind of asked for it.
Oh my goodness. Okay, so you are one of the sharpest dressed professionals I know. I believe your wife is in the business of giving sartorial advice. What's your sartorial advice for the Zoom age?
Yeah, I think set a floor, right? We don't have to go with the pocket square and tie, but right, it's just the way I think about it. Dress slacks. Right, nice shirt, sweater. You don't have to go crazy because we're all at home in the same boat. But just have a floor, sort of a dress code, and it's going to lean towards dress pants and collared shirts and nice sweaters and just because. And again, this based on what you do for a living and your background, your education. It makes a difference, right? Habit like that. I think good habits trading structure sort of creates a certain mindset and makes you feel like you're going to work, and we are. And I think that's powerful because, and not to sort of think about it in a malicious sort of way, a lot of folks aren't. And they're probably not as on their game as they maybe could be. So I think, yeah, dress code, good habits around that. You're going to work, so let's dress like we're going to work. And I think good things will come from that.
Yes, perfect. And final question. If you were to construct a Tim's greatest investors Mount Rushmore, who would be on your Mount Rushmore of great investors?
Yeah. Oh boy. If I had to keep it to 3 or 4, lots of familiar names like Warren Buffett, like Howard Marks. I'm a big fan of James Grant, who writes Grant's Interest Rate Observer. Just his ability to sort of talk about currencies and interest rates and economic cycles over a long period of time, and also put periods of froth and silliness in perspective. So I'd probably put him up there. I'd probably put George Soros as well. I've read some of his books, and the concept, and I don't think he was the first one to articulate it, but the idea, and again, this is right in your wheelhouse, right? Reflexivity, that participants in the market, impact and interact with the market and then change or influence the market's direction. And I think we sometimes forget about that it's just a coming together of people deciding to buy or sell, and those decisions then sort of feed on themselves. So I think Warren Buffett would be up there, Howard Marks, James Grant, George Soros, for sure. And again, just the idea that there's always something we can learn, either from very well-known, very successful, very wealthy people, or maybe folks who aren't so wealthy and so successful, but in this business, in this space, keep an open mind. Good ideas and good advice can come from anywhere, the famous and the not so famous.
Perfect. So Tim, as we close out, you're a frequent writer. If people want to read what you're writing, if they want to read what you're sharing, where can they find your work?
Yeah, so we would direct them, Daniel, and they can also find a lot of your work as well there. Our insights page for Brinker Capital, which is blog.brinkercapital.com. You'll see our market and economic commentary. We produce a weekly piece called The Weekly Wire. And then you'll see Daniel's behavioral finance content, which is first rate. And if you go to blog.brinkercapital.com and enter your email address, we'll push that content out to you on a regular basis. And we promise we won't try and sell you anything.
Tim Holland, thank you for helping us set a floor. I think some of us lost ours in 2020. Thank you for helping us remember the importance of changing out of our sweatpants and giving us some great investing advice along the way.
Thank you, Daniel. This was a real treat, real honor. I really appreciate the opportunity to be on the podcast. It's been awesome. Thank you very much.
Thanks again.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.